Hi everyone, welcome to today's video. My name is Angela Santalia. I started the Money Messenger project as a way of imparting some of my knowledge with regards to all matters money. So I'm sharing with you bits and pieces that I've learned along the way in my career in financial planning, which I've been doing for the last 20 years. I'm also an investor myself. So everything I teach you, share with you, tell you about, I do myself. So I'm sharing with you some of my tips, tricks, and secrets. Today we're talking about depreciation, specifically with regards to investing in property. So I'm going to teach you about a way which a lot of people, for some reason, they're not aware of depreciation. And basically it's because if somebody doesn't tell you, you don't know. So if your accountant doesn't tell you about this, or your existing financial planner, or through your own research, it's hard to know about something unless someone tells you. So I'm telling you a secret when it comes to investing in property today. Before we get started, for all of you out there that are watching live, if you could please tag in the comments box where you're watching from. I love seeing where people are watching from. And if you've got any questions with regards to what we're talking about today, please feel free to pop those in the comments box as well. I'll do my best to answer them live whilst we're on the video together. Okay, so let's get started. Today we're talking about depreciation reports and how to invest in property correctly. So depreciation, what is it? Well, basically, just like you can claim the cost of wear and tear, essentially, on, say, a work car that you may own and use for business purposes, when you have an investment property, you can also claim the wear and tear on that property. Why would you do that? Because in doing so, you actually increase the tax deductions that you can claim for a property, which means you pay less tax. So depreciation is split up into two parts. It can either be plant and equipment, which is basically your property and everything that's attached to it. The carpets, the blinds, the dishwasher, things like that. Then also you can have depreciation on the actual property itself, the building, which is the bricks works, the concrete, the actual structure itself. And they're calculated differently, but they're both as important as each other. So when you have an investment property, you need to get a depreciation report done. You do this after you've bought the property as soon as possible. And it's really, really important that you get one done, because when it comes to tax time, if you don't have one, you can't claim all the numbers about depreciation for your property. You can't just create those numbers willy-nilly. You need to get a qualified quantity surveyor to prepare a report. Now, this report will cost you about $400-ish. It is well worth it. You must get one. Regardless of how old your property is or when you bought it, go and get a report done straight away if you don't already have one. And if you're lucky enough, give that report to your accountant and he can perhaps alter your tax returns for the last couple of years and claim back some of the deductions that perhaps you didn't know you were entitled to. So the way the depreciation is worked out is different percentages depending if it's plant and equipment or if it's property, if it's the actual building. The quantity surveyor will know that and work it out for you. And it's really important because it can end up being thousands of dollars that you're entitled to claim. For example, there's a $300,000 property which I own myself. Now that property is worth $300,000, but it's partly a house and partly some land as well. So the actual component of that property is worth about $161,000. The rest of it is land and garden and driveways and things like that. Not all things you can claim. Now the actual depreciation on that part of the property, the actual building itself, is over $4,000 a year that I get to claim in my tax return, which means I get a percentage of that back from the government. So that increases my cash flow because I'm paying less tax. That extra cash flow that I have at my disposal then helps me to be able to hold the property, look after the property, perhaps buy more properties. So it's really important you get a depreciation schedule done if you have an investment property. If your property is new, there'll be more parts that you can claim, so your depreciation will be higher compared to an older property. But even if your property is a number of years old, still go and get the depreciation report done and give that to your accountant quick smart, because it is worth your while. The more you can claim in your tax return, the less tax you pay, the more cash flow you have towards investing in property. Now, there are some changes that came into force in May 2017 with regards to depreciation. The government always likes to fiddle around with things and change things. So I think they thought people that invest in property have it too easy. They obviously don't understand the struggle and the uphill battle it is sometimes and the effort we put into it. But hey, that's the government. So they made some changes that said that people that didn't actually buy those carpets, blinds, dishwashers in a property, say you bought a second-hand property, you can no longer claim some of those deductions unless you physically paid for it yourself. You physically installed the dishwasher, the blinds, all that, you paid for it yourself. So therefore, some of the depreciation with regards to plant and equipment is a little less than it used to be, but it doesn't matter. It's still worthwhile getting your depreciation report done. If you buy a newer property, which means you had it built or you bought it off the plan, bought it from a builder, your depreciation will be a lot higher because you are the one that originally built that house. So that's just something to note, but still, I wouldn't worry about it that it's the end of property investing as we know it. It's not. Just because your tax benefits are a little bit less than they may used to have been, doesn't make property any less worthwhile of an investment. And the caveat to all this is that you should never invest in something just for the tax benefits. You always want to make sure that the property, the investment, stands up on its own 2 feet and is a worthwhile investment. The tax benefits you get along the way should just be a little cream on the cake. But the thing is though, if you don't have a depreciation report, which there are a lot of property investors that don't have one because they don't know they exist, if you don't have one, that means that you're missing out on things that you can claim as a tax deduction, which means you're paying higher income tax than you should, which means you have less cash flow. So I implore all of you out there that are existing property investors, go and get a depreciation report done as soon as possible. Look around for a quantity surveyor in your local area or where the property is located. Even if you're in different states, you can use someone that's in the local area. It will cost you $400 or $500, but it is the best money spent. And that $400 or $500 that you're going to spend, that should also be tax deductible for this year for your property as well. So just ask your accountant about that one. Like I said, if you've got a property, get one done. If you're about to buy a property, you don't need to do that just yet. You can do that once the actual property has settled. And even if you have a really old property, just go and get the report done anyway. Speak to one of the quantity surveyors and they will tell you roughly what you can expect to achieve in a depreciation report. So today we spoke about depreciation reports, what they are, why they're important, and why you need one. I have met a lot of property investors that don't have a depreciation report because they didn't know it existed. So if you're not sure, ask your accountant when it comes to tax matters. Always check everything with them. Do your own research. But if you've got a property or you're looking into a property, go and get a report done ASAP. And I'm going to leave it there for today. Just a quick one. I just want to share that with you because a lot of people aren't aware of it, but it is important and it'll just round off your property investing. So if you've got any questions with regards to what we spoke about today, please feel free to pop a comment in the comments box or send me a message on the Facebook fan page for Money Messenger. If you liked what you saw today in the videos and you want to see more, please subscribe to the Money Messenger website at www.moneymessenger.com.au. I post videos like this every Wednesday, so I hope you can enjoy it and join me for next week. And a shout out to all of you that are watching live. For now, I'll see you all next week. Thanks, everybody. Bye.